This is another video which will give you the best learning experience from our channel, EduNet Tutors. It illustrates the concept of accounting cycle. As you have experienced before, after each and every concept, we will give you the best example, which is fully worked out, then giving you a guide as a student or as a learner to grasp the concept well, as well as really get an experience, a first-hand experience on how to go about these problems relating to this particular concept. Therefore, stay tuned to this channel and you'll be sure to get the best of a learning experience. At the end of the lesson, as a learner, you then should be able to identify the accounting transactions. You should also be able to prepare the books of accounts. You should be able to post transactions to ledger accounts. You should be able to prepare the trial balance, post adjusting entries, prepare the basic financial statements, and post the closing entries to the accounts. I'll then start by explaining what accounting cycle is. Accounting cycle is a step-by-step process, and the word emphasized here is step-by-step process. Step-by-step process to record business transaction activities and events over the accounting period. That is to mean the steps that the accounting transactions will go through and the events will go through until the time that they end in the financial statements at the end of the accounting period. So each and every accounting period has an accounting cycle, which then ends when the accounting period ends, and a new accounting cycle begins when the next accounting period begins. Right, talking about the accounting cycle, then these are the steps that are very important for you to understand as somebody who is learning the accounting cycle. The first step is here, and this particular step is a step where accounting transactions and events are identified and measured. We shall talk about that in detail. The second step is a step of generalization, and in generalization, we are talking about recording transactions, the books of original entry, the journal, and this include cash book, sales day book, purchases day book, sales return inwards day book, or return inwards day book, and return outwards day book. The third step is posting the transaction to ledgers. This includes both posting in general ledger and posting in the subsidiary ledger accounts. The next step is preparation of a trial balance, and the initial trial balance usually may be posted before correction of errors, before adjustments are made. So because of that, then what follows that particular trial balance is preparation of adjusting entries. So posting of adjusting entries is the fifth step, followed by adjusted trial balance. That is, after posting the adjusting entries, then another trial balance is extracted, which now takes into consideration the adjustments which have been made, followed by the step number 7, which involves preparation of financial statements. Preparation of financial statements is a situation whereby the accounting information is now summarized into statements, and the most common statements are statement of profit or loss, statement of changes in equity, statement of financial position, and then statement of cash flows. The next stage is posting of closing entries and posting closing trial balance, and finally reversing entries. Now, all these are the stages that takes place in the accounting cycle. But what you may need to know is that in many cases, you will find that the accounting cycle in some books or according to some authors usually ends at number 8, which is posting closing entries. And that is why you see the next step, number 9, and step number 10 are optional steps. In other words, the accounting cycle can end at the stage of closing entries, and that is still correct. However, A detailed accounting cycle may involve posting the closing trial balance here and posting reversing entries. Let us then start with the first step, which is a step of identifying and recording transactions and other events. For an item to be recognized in the financial statements, the item must have some features, which then makes it qualify to be a transaction for purposes of recording in the books of accounts. The first one is that it must meet the definition of an element of financial statements. Referring to the conceptual framework, there are 5 elements of conceptual framework, of financial statements, which include the assets, the liabilities, the expenses, the income, and then the equity or capital. So any item which has a qualification to be any of the 5 items is recorded in the books of accounts. Also, this particular item, for it to be recorded, then it must be probable that any future economic benefit associated with the item will flow to the organization or flow out of the organization, flow from the organization or flow into the organization. Then it has a cost or value that can be attached to it. And this is going back to the concept of accounting that is talking about the money measurement, meaning it must have the monetary value for it to be recorded. And the monetary value should be measured reliably. Stage number 2 is about generalizing. Generalizing is the practice of documenting a business transaction in accounting records, especially the books of original entry. Journal entry serves as the building blocks of financial accounting, and therefore it is very important to prepare journal entries. That is to mean this is where the process of recording accounting transactions starts. All business transactions must be recorded in journal entries or in the books of original entry, including payments, including purchases, and any other transaction that has taken place need to be recorded. The journals of the books of original entry are a chronological list of transactions and other events which the organization undertakes. Sometimes these journal entries are known as prime entry books. These are therefore where the entries are first posted from the source documents. From the source documents, the first place the entries are made are in the books of original entry. And the books of original entry therefore include the cash book. The cash book is usually used to record cash transactions. Then sales day book, which is used to record credit sales transactions. Then purchases day book, where we record credit purchases transactions. Return inwards day book, which records sales return transactions. And return outwards day book, where we record purchases return transactions. Purchases return transactions. Right, so these are the 5 major types of day books or the journals, but then we have one more journal known as general journal, and we will also talk about this particular journal, general journal. Okay, so what is it that should be included in a journal? In a journal on the books of original entry, the date must be indicated, at least a debit or credit entry, at least one debit entry or one credit entry. So a debit account used to extract account title and do not indent. We'll understand that. Then at least one credit entry also need to be there. Then an explanation of the transaction, like the check number, like the invoice number, accounts receivables name of the customer, and sometimes any other element that may need to be indicated. But what is important to understand is that a journal is one way that an account will have what's called the audit trail. So then as much information as possible is required so that when such audit trail is required, then it is easily got from the account. So that is why journals are very important. They are the original entry of transactions which are made out of the source document. Let us start with the first journal, which is known as the sales daybook. As I've explained above there, the sales daybooks are used to record sales made on credit from the source document, which is known as the sales invoice. When we make sales on credit, then we issue an invoice to the buyer who has purchased on credit. Such sales invoices are used to record in the sales daybook or the sales journal, sales daybook or the sales journal. At the end of the period, the totals in this particular sales daybook are transferred to the general ledger and recorded in an account known as sales account, the general ledger. The same transactions are transferred to the individual debtors account, respective debtors. The respective debtors accounts are recorded, and at the end of the period, the totals are recorded in the sales account in the general ledger. Let us look at an illustration of this particular situation. It says that following are the transactions of Mr. and Mrs. Kamau. Prepare their sales daybook. On 11th May 2022, sold to Famous Gupta on credit 30 shirts at 1,500 each, 20 trousers at 1,300 each, and discount of 10%. On 15th May 2022, sold furniture to Pesa and Company on credit 8,000. On 18th May 2022, sold 50 shirts to Farida at 1,600 each. On 21st May, sold on credit to Hamisi Corporation, 100 shirts at 1,750 each, 10 overcoats at 1,500 each, less trade discount of 10%. Now, to answer this question, we're going to prepare a sales journal or a sales daybook as follows. So this is Mr. and Mrs. Kamau. Sales daybook. The month of May. Sales daybook, the month of May 2022. Now what we must have in this sales daybook are following. So in the first column, we have the date for this particular transaction. Then we have particulars of the transaction. We may have folio here. Well, the folio here is the reference number. Then we have amount in details. We have the amount in details. And then total amount. Now let us start with the first transaction, which is on 11th May. This is the year 2022. May 11, the year 2022, May 11. Sold goes to Famous Gupta. So this is the transactions which were done to Famous Gupta. These transactions include 30 shirts at 15 shillings each. at 1,500 shillings each. Now this is going to be 30 by 1,500. And if we multiply 30 by 1,500, we're going to get 45,000. In that case, we have 45,000. The next transaction is a purchase of 20,000. And each trouser is 1,300. So we have 20 by 1,300, and that is equal to 26,000. The next transaction is the discount. So let's discount. Now we need to get the total, and then let's discount from that total. Discount is 10%. So we have 45,000 plus 26,000. That should give us 71,000 times 10%. It should give us 7,100 as the discount. So that the total there is therefore going to be 71,000 minus 7,100, and that is equal to 63,900. Which the next transaction is on 15th May 2022. And on 15th May 2022, sold all furniture to Pesa and Company on credit at 8,000. Now, this particular transaction is not going to be recorded in the sales journal. The reason is it is a disposal of non-current assets. And disposal of non-current assets are supposed to be recorded on the individual disposal accounts for individual non-current assets. Next is May 18, 2022, sold 50 shirts for credit to Farida at $1,600 each. So we're going to have May 18th May. So we're going to have May 18, Farida. And for Farida, we have 50 shirts at 1,600. 50 by 1,600 equal to 80,000. Therefore, we have 80,000. 50 by 1,600 is 80,000. The next transaction is on 21st May. Sold on credit to Hamisi Corporation. So we're going to have May 21st, Hamisi Corporation. To Hamisi Corporation, sold 100 shirts at 1,750. And that is going to be 175,000. 175,000. 10 overcoats at 1,500 each. And that is going to be 15,000. Let's trade discount. We are supposed to deduct trade discount. And the discount in this case, is 10%. So it is going to be 10% of the total. The total is 190,000. So it is 10% of 190,000. 175 plus 15,000 is 190,000, and 10% of that is going to be 19,000, which now we deduct 19,000. So we are going to have 190,000 minus 19,000, and that is equal to 171,000. 171,000. Right, so that is the end of all the transactions. Therefore, we need to get the total by having 171,000 plus 80,000 plus 63,900. And that is giving us a total of 314,900. The total is 314,900. And that is how to prepare the sales journal. What to remember there is that where we have sales of non-current assets, like we saw on May 15, then such sales of non-current assets are not recorded in the sales journal, but in a different journal known as general journal. We shall look at that later. The next journal is known as purchases daybook, which is used to record credit purchases from a source document known as purchases invoices. These are invoices issued by various suppliers who have supplied goods on credit or services on credit. These transactions usually are credited to individual accounts payable accounts of various suppliers in the books of the business. At the end of the period, the totals in the book are transferred to the purchases account in the general ledger and usually debited in the purchases account in the general ledger. To illustrate this particular concept, then we're going to look at the following example. The question reads as follows. An electronic company purchased goods on credit from 5 different suppliers in the month of January 2022 as follows. On 4th January, bought goods from D and dealers on credit, which include 100 table fans at $300 each, 50 tube lights at $25 each, electric irons at 60 shillings each, trade discount of 20%. On 11th January, purchase from K-Access Electronics Store on credit, 20 selling fans at $500 each, 50 heaters at 80 shillings each, 20 mixie at $1,000 each, trade discount 10% and sales tax at 12%. On 14th January, purchase from Habiba Traders on credit, 20 dozens of bulbs at 50 per dozen, 10 dozens of lamps at 40 per dozen, a parking charge of $15. On 25th January, bought from Pendo Electric Appliances, 5 washing machines at 1,200 each, paid in cash. On 31st January, bought from Babu Furniture House on credit, 8 chairs at 80 per chair and 2 tables at 500 per table. Now, the question requires preparation of purchases journal. And therefore, to answer it, we will be required to prepare purchases journal. Purchases journal for the month of January 2022. A purchases journal has a column for date, a column for particulars, a column for folio, that is the reference number, a column for details, and that is the amount in details. Then we have a column for amount in total. Right, now we begin with the first transaction, which is a transaction on January 4th. So we say on 4th January 4th, the purchases were from D and dealers. So from D and dealers, the company purchased the following. On 4th January, the company purchased 100 table fans, And each fund is 300. 100 table funds at 300 each. So that means that the amount is 30,000. Then we have 50 tube lights at 25 shillings each, $25 each, and that will then give us 50 by 25 is 1,250. The next one is 40 electronic irons. So 40 irons, each at $60. 40 at $60 is 2,400. And then there was a trade discount of 20%. What's going to happen is that we need to determine the total, which is equal to $30,000 plus $1,250 plus $2,400 to give us $3,365. We multiply by 20% so that we get the discount, which is $6,730. And this is equal to the discount is equal to 20% of 3,620. 33,620 multiplied by 20%, and that will give you the discount. Now, after getting the discount, then we need to subtract the discount from the total, 33,650 minus 6,730. And that should give us a total of 26,920 as the net amount going forward. The next transaction is on January 11. The following items were purchased on credit from K Access Electric Store. First one being 20 funds, selling funds, 20 funds at 500 shillings each, dollars each, at $500 each, and that will give 10,000. 50 heaters at $80 each, 20 mixie at $1,000 each. That should give you 20,000. 50 by 80 should give you 4,000. Right, so in this case, we have a total of $34,000. Now from $34,000, we need to calculate a trade discount of 10%. Discount is 10% of 34,000. That is the total of 10,000 plus 20,000 plus 4,000 is 34,000. 10% of 34,000 is 3,400. If we subtract that, then we're going to have a total of 30,600. 30,600. After determining 30,600, we need to add sales tax. We need to add sales tax. Sales tax is simply 12% of the total, and the total is 30,600. Right. So if we multiply that by 12%, we're getting 3,672. 3,672, which we now add to 30,600 in order to get 34,272. On January 14, the company bought 20 dozens of bulbs at 50 per dozen. These were purchased on credit from New Habiba store, New Habiba traders. There were credit purchases and therefore recorded here. 20 dozens at 50 each per dozen, and that is equal to 1,000. 1,000. 10 dozen and each dozen equals to 40, and that will give a total of 400. Right, so this is 1,400, and there was a packing charge of $15. So we need to add a packing charge of $15. Parking charge is $15. Right, so that the total in this case is going to be 1,415. 1,415. On January 25, the company bought from Pendo Electric Appliances 5 washing machines at $1,200 each and paid in cash. Now, this particular transaction is not going to be recorded in the purchases journal because it is a cash transaction. Cash transactions are supposed to be recorded in the cash and not in the purchases or sales journal. On 31st January, bought from Babu Furniture House on credit the following: 8 chairs at $80 per chair, 2 tables at $500 per table. These 2 transactions are also not recorded in the purchases journal because they are purchases of non-current assets. And purchases and sales of non-current assets, purchases of non-current assets are recorded in the respective non-current assets account. For example, chairs account or furniture account. That is the reason why this particular transaction will not be recorded in the purchases journal. Therefore, at this point, we need to determine the total for all. And the total for all the transactions equals to 62,607. So we have 62,607. Right, so we have 62,607 as the total, which should be transferred to the purchases account in the general ledger. So in the general ledger, we're going to debit in the purchases account 62,607. While individual transactions for D and dealers, that is the D and dealers, the K electric store, and New Habiba traders will be credited in the various suppliers accounts, individual suppliers accounts. But the double entry is made of the total in the purchases account in the general ledger. At times, goods purchased from a supplier may be returned fully to the supplier or partially. And this decision to return the goods may be informed by the following reasons. The goods may be defective, or the goods may have been spoiled in transit, especially where the supplier was in charge of transportation, or the goods may not be as per the order that was made. In this case, a debit note is prepared by the buyer who is returning the goods to the supplier, and then the note is sent to the supplier. A purchases return day book is also prepared for recording such goods returned. These transactions in the purchases day book are then debited in the individual accounts payable account of the various suppliers to whom the goods have been returned, especially after the supplier has accepted return of such goods. And then the total of the transactions in this particular book are then transferred to the return outwards day book in the return outward. The transactions are debited to individual accounts payable accounts for the individual suppliers who have accepted return of the goods, especially after they have accepted that the goods were returned for a genuine reason. And then the totals are transferred to the return outwards account in the general ledger, which then becomes a credit in the return outwards account. To illustrate this, let us look at the following example. Enter the following transactions in the purchases return day book for the month of March 2022. It is as follows. On 9th March, return goods to Barra Corporation, $1,900. On 11th March, goods returned to Cambi Limited, being not according to sample, worth $1,400. On 28th March, allowance claimed from Marble Corporation, Marble Limited, on account of a mistake in the invoices of $200. On 31st March, return goods to Medal Limited of $1,700, less trade discount of 10%. Let us consider this question to illustrate this concept. It is as follows. Enter the following transactions in the purchases return day book for March 2022. On 9th March, goods returned to Barra Corporation, $1,900. On 11th March, goods returned to Cambi Limited, being not according to sample, worth $1,400. Allowance claimed from Marble Limited on account of mistake in invoices, $200. Return goods to Medal Limited for $1,700, less trade discount of 10%. To answer the question, we're going to prepare purchases day book as follows. There is a column for date, column for particulars, a column for folio, whereby this folio is just a reference number that may be given to a transaction, the amount in details, and amount in total. Right, so at this point, then we want to start by entering the transaction as follows. On March 9th, return goods to Barra Corporation. Barra Corporation. And that is $1,900. On 11th March, goods returned to Cambi Limited, not being according to sample. So here is Cambi Limited. Amount being $1,400. On 28th March, allowance claimed from Marble Limited, $200. And lastly, on 31st March, Medal Limited, return outwards to Medal Limited, where we have the amount to be, the amount returned to be $1,700, less trade discount. Less trade discount of 10%. So it is 10% of this 10% of the goods returned, which is 170. Now we subtract 170 from 1,700 and we have 1,530. Now the total of all these will become 5,030. And that is how to prepare purchases daybook from information given. So that is how to prepare purchases returns daybook. The next concept is about sales return daybook. In a situation where goods are returned by a customer to the business, such returns are recorded in sales return journal or return inwards journal. And a credit note is issued and sent to the customer who has made the return. It is the credit note information that is entered in the sales return daybook or return inwards daybook. The transactions are then credited in respective accounts receivable account for the various customers who have returned goods, and the totals are transferred to return inwards account in the general ledger at the end of the period. They are debited in the return inwards account while a credit is done in the various accounts receivable accounts of the various customers. Let us solve this question to illustrate this concept. The question reads that prepare the sales return book in the books of Calmi Company Limited from the following transactions. In 2022, month of April, on 6th, on April 6, 2022, return goods by Percy Company Limited. Return goods by Percy Company Limited, which include 2 table funds, $600 each, less trade discount of 15%. On 12th April, Lamy Corporation returned defective goods valued at $4,250. To answer this question, we're going to prepare sales return daybook, which is the return inwards daybook. Calmi Corporation's sales return daybook. Date, particulars, then a column portfolio where we record any transaction reference that is important to us. Then we have details, which may be amount in detail, and then amount which is in total amount. Right, so on April 6th, on 6th April, return goods by Percy Corporation. So we have Percy Corporations Limited. Percy Corporation Limited returned 2 funds, table funds. Each fund is 600, and that gives a total of 1,200. 1,200. Then less trade discount. The discount is 15%. So we need to determine 15% of 1,200, and that is equal to 180. So you need to subtract 180 from 1,200, and you get $1,020. On April 12th, Lamy Oil Corporation returned defective goods valued at 4,020. We have Lamy Oil Corporation, 4,250. So we get the total of this journal, and the total of this journal is 5,270. This total should be transferred to sales return account in the general ledger. Sales return account in the general ledger. That is where the total should be transferred. While the individual transactions will go to the individual accounts, receivable accounts of the various customers who have returned their goods.